Good afternoon, everyone, and welcome to Winning at GovCon. What will make your GovCon company valuable to today's buyers? I'm Jennifer DeCamp, Director of Client Services at sbLiftOff. sbLiftOff is a national M&A firm serving the mid-market with deep expertise in GovCon. So I'd like to take a moment to introduce you to our panel today. Our first speaker is Sharon Heaton, CEO of sbLiftOff. Sharon has advised on transactions totaling more than $12 billion in deal value and has focused on bringing high-quality M&A advisory to the mid-market GovCon space. Sharon got her law degree from the University of Chicago Law School, a BA from Parner College at Columbia University, and has been associated with the law firms of Skadden Arps and Latham and Watkins. Next, we have Emily Zankman. Emily is a senior business banking relationship manager at M&T Bank. M&T is the 11th largest bank in the US with $204 billion in assets and a footprint ranging from Maine down through Richmond. Emily has been with M&T for over 9 years and is passionate about supporting GovCon clients in our local communities. She partners with her clients to strategically customize lending, deposit, and cash management solutions to their unique needs based on a collaborative assessment of their operating model, industry intricacies, and goals. Emily holds her bachelor's degree from Washington and Lee University, MBA from University of Maryland, and passed level 1 of the CFA program. Emily is on the DC committee of the National Veteran Small Business Coalition, nominating committee of the Small and Emerging Contractors Advisory Forum, and Community Action Committee of CREW, Northern Virginia. Next, we have Adam Altus, Managing Partner of Sier Capital Partners. Sier Capital Partners is a lower middle market private equity firm making investments in companies between 2 to 20 million of annual EBITDA. Adam is responsible for overseeing existing portfolio companies and executing new investment ideas. He recently served as the chairman of Integrated Laboratory Systems, LLC, a government contractor focused in the life sciences industry. Adam graduated from Vanderbilt University with a double major in history and business strategy. He currently lives in New York City. Over the next hour, we encourage you to submit questions through the Q&A option at the bottom of your screen. You can submit questions throughout the presentation, and the panel will take the last half of the webinar to answer your questions. So let's get started. Okay, Sharon, why don't you kick us off by giving us insight into winning at GovCon?
Absolutely. Jennifer, thank you so much for those introductions. One of the things to think about, whether you're buying or selling a company, is that there's actually 2 transactions going on simultaneously. If you're the seller, the first thing that you need to do, by far the most important thing to do, is to run your company well. It's very important that when you're involved in the sales process, that you are not seeing company decline because you're focusing on the transaction. So you have to work on your company and work on the transaction. You've got 2 jobs, but the buyer has 2 jobs as well. One transaction they're working on, of course, is with the seller to acquire that company. And the second, in almost all circumstances, is finding their financing. They'll bring some level of equity to the table, but they're going to need, generally, there's going to be debt involved. That's where Emily comes in. So I'd like to start this webinar by asking Emily to speak from the perspective of a banker. What is it that you look for when you're determining whether or not you're going to provide financing for somebody who wants to acquire a GovCon company? Emily?
Absolutely. Thank you so much for the kind introduction, Sharon, and thanks for everyone for joining today. As Jennifer mentioned earlier, been with M&T for 9 years and I'm blessed to have the opportunity to work with GovCon companies such as yourselves every day. At M&T, we pride ourselves on being a true strategic partner, and that means working in conjunction with advisors such as Sharon and Adam to ensure we're not only helping our clients with their current needs, but also making sure that they are well positioned to either 1, take advantage of a future growth opportunity, such as buying another company or winning more contracts, or 2, prepare well in advance to sell your company at a high multiple. To speak to the second point, ask yourself, what's your most valuable asset? If you're a GovCon owner on the line, your answer will likely be my business, of course. And eventually that plan might be to turn the business into cash. Many business owners see the sale as an event, They may think that they can wake up one morning, find a buyer, and make a sale at a high multiple. However, that's one of the biggest mistakes you can make. Preparation for a sale takes years, and if we're doing a good job of advising, over years, you're working on a strategic plan around 3 pillars: transferability, predictability, and sustainability to maximize value as well as make your company well positioned such that a lender like M&T can finance the acquisition with the buyer. So first, to speak to transferability, you want to ask yourself, will the business continue to perform after I'm gone? If it's just you or a few people in your business being the main operators 24/7, that's going to be a harder business to transfer. For a lot of GovCon companies, the most important asset within the business that really drives the value is the people. Through the people, you bring a specific skill set or capability that a company wants to acquire. It's crucial to make sure the person buying your company is a cultural fit that will facilitate your most valuable asset, being your people, staying on after a sale. The major reason integration fails is a mismatch in culture, and it usually comes to the forefront pretty quickly after the first year of the sale. The second pillar to keep in mind is predictability. By predictability, I mean looking at past performance. Will the buyer see consistency with core cash flow? The more predictable a company is from a cash flow standpoint, the higher the multiple can be. Also, of course, when lenders see consistency, they are more well positioned to finance the acquisition with the buyer. A lender will look at things like, historically, does your contract backlog reflect good quality ongoing work? Has there been a long track record with your customers? Is there additional work in the pipeline that will keep the company either at the same level or growing even further? For example, if I'm Booz buying a company that does work for the DHS, hopefully I'm buying a company right at the time that they've won a recompete and there's a few years runway. However, if that's not the case, and say there's a recompete coming up next year on the largest contract, hopefully the company has recompeted 4 times and maintained the work over 20 years, for example. In that case, the company has the relationship that they can point to, which will give the buyer and the lender confidence on the runway to build upon. The last pillar is sustainability. By sustainability, I mean, is there change risk from customers, competitors, suppliers, new entrants, or substitutes? To put it simply, if you're a buyer and you're buying an 8A who has all 8A contracts and they're nearing graduation, that may not be something that's going to be sustainable. You want to be buying something that has a diversity of contracts rather than being reliant on set aside or small business work, so you can make sure to carry the company forward in its current state, sustain it, and take it to the next level. To put it all together as a business owner, think of planning a sale as solving a Rubik's Cube. You're naturally going to want to concentrate on the business face of the Rubik's Cube, and as you should, to keep the company running and growing, as Sharon mentioned just now. However, there are many other sides that need to come together to maximize value. A nice thing that you can engage in upfront is to examine these sides rather than finding a problem area right before close. Something you can do is mock due diligence. In mock due diligence, an outside party, or you can do it yourself, can come in and complete a thorough assessment, essentially going through the paces of what would happen during a sale, and advise you where to reallocate and invest funds to maximize values on items such as upgrading your accounting software, upgrading your legal frameworks, or obtaining a new level of compliance. When you get these results, don't lose focus on that business face of the Rubik's Cube, though. Hire advisors that can work on different sides that won't operate in a vacuum, but rather collaborate to make sure that when it comes to the sale, all the sides fall into place. And that's where your bank comes in. On the sales side, if you've had a good banker, they've been in the trenches with you for years and have been helping you create the value through strategic growth. On the buy side, they've also hopefully been working with your company for years and can help you examine if buying another company is going to bring yours to the next level, as well as have a conversation of whether it is with your buying power. Once you make that determination, the financing comes next. At M&T, we're able to look at loans from both a conventional and SBA standpoint. Conventional can be the quickest way to get the deal across the table if the historical cash flow of your company can handle the debt and there is sufficient collateral. However, the SBA is a wonderful tool to leverage for smaller acquisitions under 5 million if you're basing your affordability on projections. With the SBA, there's the added benefit of being able to put down as little as 10% and extend the term of the loan out up to 10 years. You don't have to come to your banker and know exactly how you will finance an opportunity. In fact, you might leverage different programs to finance different opportunities. The important thing is you have a strong relationship with your banker and that they take all the pieces of the puzzle together, both by looking at the financial picture of your company as well as the financial picture of the company that you're acquiring, and you together determine what makes the most sense. From the banking side, although interest rates have gone up, they're still favorable, and we haven't seen activity slow down much. So it's definitely still a good time for M&A. With that, I'll pass it back over to you, Sharon.
Oh, Sharon, you need to unmute yourself.
Thank you very much, Emily. That was extremely helpful. I appreciate that. And I've got a bunch of questions that I want to ask you based upon what it is you just said. And one of the things that I heard you say is that there's different kinds of bankers. There are some bankers that basically do asset-based lending, and they only will do that. There's others that will do cash flow lending, and we could talk about that in a few moments. Just like there's different kinds of bankers, there's different kinds of buyers. One of the things that clients will often say to me as they're getting ready to go to market is to say, I only want to sell to a strategic. I don't want to sell to a private equity. Very common to hear that. The second sentence out of their mouth is, and I will not provide any confidential information to a competitor. Well, kind of by definition, that strategic is likely to be a competitor in some way. The private equity market is not a monolith. It is an incredibly diverse market. And particularly in GovCon, we've been hearing about large PE firms coming in to buy very large companies. But in fact, we're now beginning to see other PE firms, smaller PE firms, really understanding the value of lower mid-market companies, particularly in the GovCon sector. It's my pleasure to introduce Adam Altus, who is with Sier Capital. And Adam, why don't you talk a little bit about Sier and what your role in the market has been?
Sure. Thanks, Sharon. Appreciate you having us on. We're a little bit of a different beast. I think generally large private equity funds have a reputation for coming in, slashing costs, firing people, and trying to get water out of a rock, right? How can we figure out a way to get as much out of, with as little investment? The first question we ask ourselves every time we buy a business is, how do we double? How do we grow? How do we add headcount? How do we share equity with our management teams? How do we incentivize the owner to stick around and make the business want to succeed? Every transaction is a small miracle. It's just the way it is. It's the beginning of a relationship, not the end. So for us, we've been fortunate enough to do roughly 10 deals, about 20% of which have been in the GovCon space. As an owner of a government contractor, you've got to ask yourself an honest question. Why do I want to sell this business, right? A good answer to that question is, I'm nearing retirement age, 90+% of my net worth is tied up in this business, and I want to move on to the next phase. That's fine, but the next question has to be, okay, now what, right? How does this business operate without you? So what we look for are these really solid management teams that either are ready and able to take the business to the next level, or even want to participate with us in management buyouts. Actually, in all of our transactions, we invite the entire senior management team to co-invest with us into the GP of all our deals, which I'm happy to say has been a very lucrative experience for everyone we've worked with thus far. To answer Sharon's question directly, every time we do a transaction, it's in a separate silo, totally distinct and independent of all of our other portfolio companies. That allows us to work within the framework of some GovCon small set asides, be it small business or otherwise. And we've figured out what we think is a really neat strategy to maintain business as usual within companies that we're buying without violating any of the set aside rules. Hopefully that answers your question, Sharon.
Sharon, you have to unmute.
Yeah, absolutely, Adam. That's very, very helpful. Okay, so let me do an introduction. I'm Sharon Heaton, sbLiftOff. Delighted to be here with everybody today. We basically help people buy and sell companies. I'm going to talk about it more from the selling company perspective today, although there'll probably be some comments on the buy side. I was very taken with what Emily said about the first thing to know is your company transferable? That is a key issue. We all know that the business owner will have a business, but the question is it transferable? That is, does the business exist outside the participation of the person who owns the company? I did a meeting with a business owner, and we were talking about him wanting to sell the company. It was about 19 million in revenue. It was a decent sized company. And while we were talking, at least 4 or 5 different people who worked at the company came in to ask him questions. And they were asking him very basic questions. This broke, what should I do? So-and-so didn't come into work today, how should we handle it? And I turned to him after about the 4th or 5th person and said, you don't have a company. What you have is a job with staff. What would happen if you went out into the parking lot today and got struck by lightning? And he said, oh my gosh, everything would stop. I said, well, in order to sell your company, we absolutely need to change that structure. As Adam made reference to, the support of a secondary team outside of the ownership is very important to ensure the value of that entity. If you are a single point of failure, that's going to be too risky, as well as the fact that a buyer is going to be putting hopefully millions of dollars into your pocket, and that could diminish your interest in working really hard. So the buyer wants to make sure that that company is there and energized and capable of functioning outside the owner themselves. So that goes to the issue of transferability. Is it actually transferable to somebody else? On the predictability, and Emily, I'd like to get your thoughts on this. You talked about, cash flow predictability. Now we're in GovCon here. Sometimes people win a new contract. It's not somebody that they have a long or deep relationship with, but it can be a game changer. It might be, I had one company that was managing military operations, military bases, and they had been, basically a $10 to $12 million enterprise each year. And then they won a tremendously large contract that was going to go on for at least 5 years. How would you, as a banker, look at something like that? Would you look to see what the backlog is going to be that they've now won, or would you value it only based on the history of what they had been before?
That's a great question, Sharon. And yes, definitely, it's a combination of the two. But the GovCon clients are a unique animal in that, like you mentioned, you can win a contract and you can really grow overnight. So in the situation that you mentioned, that can be an ideal situation because they've just won a contract and we know that there's a 5-year runway. So that absolutely comes into consideration. But one of the important things is to look at, is there a diversity of contracts, or is it just this one large contract that they're fully relying on? So in that regard, it will be important to look at the historicals just to make sure there's a diversity of the relationship. But we'd combine that with looking at the pipeline of opportunities as well as the contract backlog of the work coming in, and use the two to decide the best path forward.
That goes to kind of the timing of when should a GovCon owner think about going to market. And we'd like to joke about the owner's conundrum. When things are going extremely well and you've won all of these new contracts and you're having fun, that's the time to sell. The time that you've just lost a contract and employees are walking out the door and margins are decreasing, unfortunately, that's the time not to sell. That's when you have to kind of dig down deep and rebuild it in some way. So that owner's conundrum is particularly real in GovCon, because let's be honest, a GovCon company is a portfolio of its contracts. And as a portfolio of its contracts, you have to be looking at how much backlog do I have? Not pipeline, but true backlog, as well as when are the recompetes coming up. If there's a major recompete coming up in the next, let's say, 18 months, that brings risk to the buyer, and that buyer is going to decrease the value. In fact, the buyer might have a difficulty getting capital at all. So there is a kind of a portfolio of contracts approach that really will impact the thinking of when a seller should bring a GovCon company to market. One of the things that I think that you also mentioned, the sustainability. Does the company, could you talk a little bit more about the sustainability, contract backlog? Because by definition, contract backlog goes down every year. If you took it at a snapshot in time, Whatever you have in 2024, 2025 is going to be less than what you have for 2023. How do you as a banker look at that, Emily?
Yeah, good question. So I think it goes back to diversity of contracts, really. So if you look at the backlog and you look at the current contracts in place, is there a diversity, or is it a company that's completely dependent on set aside or small business work? So if we're looking at a company, and I think I gave the example of an 8A, if they're 1 year out from graduation, but of course you're looking at the backlog and it's all 8A contracts, I think of course that's not going to be in a situation where a buyer is going to come in and want to offer a whole multiple there. So the diversity of contracts part is extremely important. And of course, it's great to see if there's a track record with the agencies. That may or may not be the case, but the diversity is the huge thing that we'll look at for the sustainability side of it.
Excellent.
So sorry to cut in, there's from the equity side of the house, that's something we really spend a lot of time on also, right? Because a lot of these businesses are growing, which means their backlog is growing, but their revenue is growing really fast. So really the best thing you can see is a business that's growing with a backlog that's increasing, right? If you're growing 20% month over month, but you're winning more than 20% every month in your backlog, that's a really healthy experience in our view for a growing business. I'm sort of less afraid of businesses that are all set aside contracts. It strikes me as somewhat unreasonable to ask a small business to go win large contracts if they don't have to. That's kind of not the path of least resistance. We think about that when we buy businesses, and we talk about, okay, what's the CapEx spend going to be to truly go large 2, 3, 4 years down the road? What's our percentage of failure or percentage of success in that potential, endeavor? But really, the best people to buy businesses from are folks that don't want to sell it, right? It's guys that got men and women that love their companies, that are very bullish on the future of it, but just know they're not the right person to go from 30 to 60 million of revenue, or are willing to commit the 70 to 80 hour weeks they've been working. So for us, we bridge that gap through some sort of connectivity between buyer and seller. That's a seller note, it's an earnout, it's a rolled equity position. We feel really strongly about figuring out ways to create alignment. If I could distill our investment thesis down into one word, it would be alignment. How can we make sure that we'll succeed or fail together as buyers or sellers?
Let's talk about that just for a moment. Sellers get paid for their company in 4 ways. One is cash at close. Every seller wants as much cash at close, and that becomes a fairly negotiated point. The other 3 are, first, seller financing. Seller financing is basically an IOU. The buyer is saying to the seller, I'm giving you this cash now, but I'm giving you a note for another $1 million, $3 million, whatever it might be, that will get paid out over time. What's very important about that is that it is always subordinated to the bank financing. So the seller must understand that the bank financing comes first. What's really important for the seller to understand is who is the buyer. Is this an experienced buyer that has done seller financing before and always met those obligations, or is this a first time and they're kind of trying? As Adam said, that seller financing can create alignment. The seller cares a lot about who that buyer is and whether they're going to be successful. So they've got cash at close, seller financing. After that is equity rollover. And a lot of sellers don't seem to think about this in advance. You can sell your company, but not sell 100%. Very often buyers would like you to continue to hold 10, 15, or 20% of that company. And that becomes a relationship between the buyer and the seller. As Adam said before, the closing of the transaction is in fact the beginning of the relationship, not the end. At sbLiftOff, we kind of joke about the entire M&A process as a bit like dating. You start off, you put your teaser out, your confidential information memorandum, and you talk to a lot of different people. Eventually, you talk to one party, and they're going to be your selected buyer, and you sign a letter of intent. It's kind of like an engagement ring. The important thing about that letter of intent is that it's a commitment that the seller will not continue to shop that company. And the buyer is going to open up their wallet and start spending a fair amount of money. The the no shop provision, the exclusivity, is essentially the commitment that the seller makes to the buyer while the buyer is spending this money. The closing of the transaction is truly the wedding. And as Adam said, that's the beginning, not the end. So I think sellers really need to think of it in those terms, particularly if they've got seller financing or if they've got equity rollover. The fourth, of course, is the dreaded earnout. And I think that, lots of sellers start off by saying, under no circumstance would I think about doing an earnout. And the reality is earnouts get a bit of a bad rap. It depends upon how they're structured. If an earnout is structured based upon the profitability of the company, that is a litigation magnet waiting to happen, because the buyer will have sole control over what the earnings of that company are. If, however, the earnout is based upon something that's objective, then it becomes a much better play. So, for instance, I have sellers who are say to me, "We have this recompete coming up. We know we're going to win. We are so close to the agency. We've been doing great work. Yes, they have to go through the competitive process, but we think that we're absolutely going to win this contract." So I would then say to the seller, "Great, let's share that risk." The buyer doesn't want to pay for something that hasn't happened yet and potentially might not, but they're willing to pay for it if in fact it happens. Well, an earnout is a way of sharing the risk on what the future events are going to be between the buyer and the seller. So earnouts, properly structured, really are a way of bridging the gap of understanding. Buyers want to pay for what's on the table right now. Sellers often are very enamored with what's going to happen in the future. Earnout is a way of bridging those two. So those four different mechanisms are important: cash at close, seller financing, equity rollover, and then earnout. One of the things that Adam said that I think is so important is that on the day of close, the seller will know more about that company than the buyer will. I don't care the level of due diligence that the buyer does. The buyer is learning they're drinking from the fire hydrant. The seller wakes up knowing all sorts of things. So the buyer is always a little nervous. Is the seller getting out because they know something and they're trying to dump their problem on me? Well, from a buyer's perspective, if a seller is willing to do seller financing or an equity rollover or an earnout, that's a form of communication. That's a way of saying, I believe in my company. The things that I'm telling you are not simply sales spin, but in fact, the reality of, I think, how it's going to go in the future. Adam, as a buyer, how do you think about those things?
So I think I have a little bit of credibility on this. We just sold one of our GovCon businesses earlier this year, and we took a third of our proceeds in rollover equity. So we asked for it, but we've taken it as well on the other side. I think of it in one word: it's trust. Right? There's two things going on with respect to earnouts or rolled equity. It's trust that the company's in good hands, that the existing management team and the seller is going to help move the business forward and help it grow. With seller financing, it's the seller trusting the buyer that they won't drive the company into bankruptcy, because that's really what we're talking about. So the way we hear it, if a seller wants no seller financing, no rollover, none of the pillars that Sharon just mentioned, it means that they're not sort of willing to eat their own cooking, and it doesn't really work for us. We won't do a transaction if the seller is not willing to have some sort of upside, some sort of risk in conjunction with the buyer to keep them motivated. For us, it doesn't make sense. I know, a lot of bigger firms don't care. They think about, hey, I'm going to buy this business, I'm going to replace everybody with my own people, and I'm smarter than the seller. I'm smart enough to know that I'm always dumber than the seller 100% of the time, no matter what. So we're pretty focused on creating alignment and hopefully giving the seller a big second bite at the apple, in a way where if we're buying your business for $20 million, hopefully that 15% rolled equity can be worth more than your original $20 million. We're willing to make the investments to do it. We're willing to invest in the people and do all the things that you were never able to do. It's not reasonable for a business owner who makes $4 or $5 million a year. It's not reasonable for me to sit back and say, well, why didn't you spend $2.5 million on CapEx? Well, it's obvious. You want to put the money in your pocket, right? We don't have that problem. We're in the growth business. So we're trying to figure out a way to reinvest the company's cash flows back into it to help it grow.
Adam, a question has come in that's really related to you, which is how can you, as a PE company or a PE
Mhm.
firm, um, maintain the set aside for, let's say, small business, even with the affiliation rules?
Okay, I want to caveat this by saying I'm not a lawyer, I'm not an expert on this, but I listen to a lot of people that are smarter than me. Here's why our firm's able to do it. We have all of our companies are in distinctly different entities. There's no cross collateralization between our lenders. There's no crossover between our equity holders. Every time we buy a company, it is distinct and different. We do not have one large fund of capital that we pull on for all of our deals. That's number one. If you have that large pool of capital, it likely won't work. There's a nuance around control, around who operates and controls the business. We do not run businesses. Management teams, CEOs, sellers, those people run businesses. So my understanding, and again, not a lawyer, not an expert, but have been schooled on it by folks that are, as long as there's a legitimate group in place running the business that isn't a private equity firm that controls other businesses, there are ways to work through it. Look, there's always a reason to say no, right? Like people are always able to raise their hand and say, no, it's too hard, it's too confusing, I don't want to do it. But when there's a will, there's a way. And I do think with appropriate counsel and, staying within the SBA framework, there is an opportunity to execute in that fashion.
Incredibly important point, Adam. As I started to say at the beginning, for a PE firm that has committed funds under management, when you read their website, it says $320 million looking to deploy in the lower mid-market. That's probably not going to work in GovCon if there are set-asides involved. Now, there are some set-asides that are extremely difficult, even under a structure like Adam's, where they raise money for each deal. So, for instance, if it's a SDVOSB or a veteran set-aside, very challenging because the veteran, there needs to be one or more veterans that own 51%. If, in fact, Adam's team is putting together the capital, well, it's going to be very hard for a veteran to have that kind of equity percentage. It's a little unusual, well, ironic actually, because the rules that are designed to prevent fraud, that is to make sure that veterans actually are in control of veteran-owned companies, actually have the perverse effect of making it very hard for those veterans to sell their companies. In contrast, if in fact you are a small business set-aside company, that's where the structuring that Adam is talking about comes in. And it is coming to the table with specific investors who are making an investment into that company, and then ensuring that none of them actually have control of the company, because as Adam said, you really want management running that company, not the investors. Adam, is that a fair assessment?
Every situation is different, so I can't speak broadly about every single set aside. I can say at a high level, when there's a will, there's a way, and if folks like myself are willing to waive certain rights, which I am, in order to stay within these set asides, it can be done. So don't be totally scared off by any non-strategic buyers. That there are ways it's been done. It can happen.
Adam, you're relatively new to the GovCon market, something that you've only been doing for a couple of years now.
You can't see the scars on my face and my.
Well, that's what the beard is for, isn't it? It's to cover the scars.
Right. That's right. Sorry.
What made you open to the idea? Because generally, the world kind of divides into three categories. People who would stay in GovCon, that's what they know they're comfortable with. People who would under no circumstance invest in a GovCon company. And then there are some who will kind of put their toe in and look for a GovCon company that might have some commercial and some GovCon elements. What was the thinking of you and your firm when you decided to, move over and do some GovCon investing while you're also doing commercial investing?
So the first time we looked at a government business, I spoke to probably 15 or 20 of my peers. And the minute the word government came out of my mouth, they turned off. They said, "Oh, working with the government's too hard. You don't want to do it. It's not for us." That made me super interested, right? Because that means there's groupthink going on, and it's be greedy when others are fearful and be fearful when others are greedy type experience. So we dug in real hard once we kind of understood that the majority of investment groups were not paying attention to this asset class. What we found was almost exactly the opposite of what everyone says. Myth number one, government's a bad payer. Well, they might be a slow payer, but they pay their bills overwhelmingly. Number two, margins are low. Totally not our experience. There are firm fixed pricing contracts, and people on this phone call know much better than me. There are really meaningful margin opportunities in the federal government. The federal government is such a humongous behemoth of an organization that to try and classify it in one or two sentences is totally inappropriate. And then number three, I don't care how many widgets you sell on the commercial side, you don't know who you're selling to 3 or 4 years from now. It just doesn't happen. In government, you have quite a bit of visibility and predictability with respect to where your clients are coming from. So for us, once we did our first deal on the government side, we kind of liked it, and we thought it was a really underrepresented space from an investor community standpoint. We had a fantastic outcome with it. Our management team did great. We were very lucky to be surrounded by really, really talented, hardworking people. And then we did another one, and I'm hopeful to do a third again soon. So I think it's this groupthink and sort of these myths that we find to be totally inaccurate that kind of got us interested and involved in the space. But we'd love to buy everybody's business on this phone call. Send them over. We're in the market. We're buyers. Send them over. We are buyers.
Now, let's talk a little bit about sizing out. That is,
Okay.
you're a small business company. Let's say that you're under a $30 million NICS code revenue limit. If somebody comes to me and they're under a $30 million NICS code limit and their current 5-year revenue average is about 16 million, well, they're not going to size out for quite a while. A buyer has an opportunity to come in and double the size of that company before having to give up the small business set aside. In contrast, sometimes companies will come to me with a $30 million NICS code and a 5-year revenue average of 27, which
Right.
definitely means that the buyer is going to come in and have to take that bridge from the set aside world to full and open. Adam, I think that you've stepped into that role. How do you think about that?
Mm-hmm. Okay, so first things first, sounds like a good problem. Sounds like business is growing, and sounds like if it's going to phase out, the business is at least staying flat or growing to begin with. So when we're underwriting this thing, when we model out, bear markets and negative scenarios, those are a lot worse than continuing to grow and sizing out a small business set aside. So for my first instinct is, that's one of those good problems, right? Business is growing. However, we spent a lot of time getting smart on what that transition to free and open means. Who are the right people that have to do it? What sort of software is involved? Do you need to start insourcing parts of your business, finance, business development, HR, so on and so forth? And where we came down on it from is, do you have the right people in place to do it, yes or no? If that answer is yes, great, good luck. If that answer is no, you probably got to go find them. So it's something we're thoughtful about. We modeled out a meaningful 7-figure investment over the next 5 years to do that. And it's just something I think we have to be eyes wide open about going into it. But again, to me, it's a lazy perspective to say, oh, this business is sizing out, therefore I don't want to buy it, therefore I'm out. I think given the time to truly understand what sizing out means, it means it's a growing company. You're doing something right. That combined with the fact that, Sharon's educated on this, Sharon's educated me quite a bit on this. There's a lot of stickiness to small contracts that have been won while you're small that can stay with you after you're big. So to me, if you're a private equity firm complaining that you don't know where your revenue's coming from, 7 or 8 years down the line, I challenge them to look at their broader portfolio and walk me through where, 7 or 8 years of future earnings are coming from their commercial business. And, here's a spoiler alert, they have no idea, right? So I think it's a bit of a hollow complaint that people in my chair make.
I'd like to ask Emily the same question. You as a banker, let's say that there's an M&A transaction happening. It is the target company is a small business. They've got a 5-year revenue average of 27 under a $30 million NICS code. The buyer comes to you and says, we want to buy this company. We're putting down equity. We're looking to, get an appropriate amount of debt on it. How do you as a banker look at the risk associated with moving from the set aside world to full and open?
Yeah, it's a great question. It's sometimes like jumping off a cliff, right? A bit there. There can be a high level of risk in going to the next level. But as Adam said, it's a good problem to have, right? You're growing. You just want to make sure that you have the right advisors and you have the right game plan when you do graduate from that NAICS code. So if you already have the relationships and you can speak to that, I think nothing happens in a vacuum, right? So if there's a plan and there is a plan of attack and there's the relationships and there's the partnerships that can get us comfortable around it, I think it's something that there can be a conversation, but there definitely needs to be a framework around that to mitigate some of the risk.
Very interesting. It's kind of analogous to when you bring your company to market. When you bring your company to market, it's probably better if you've been thinking about it for a while beforehand to make sure that you take the various steps to ensure the transferability of your company. Kind of the same thing when you're getting ready to size out. It's not something that you should look and say, oh my gosh, I'm at 29 million. I got to start dealing with this. You should be thinking about that when you're 24 million, when you're 25 million, when you still have years to go and walking into that. Adam, it seems to me as though there's actually an opportunity for investors to be buying these companies because since there is more risk as you're getting ready to size out, the multiple does tend to go down just a little bit. That is, you might be able to get a higher multiple on a company that is 16 million in 5-year average than you might be able to if you're 27 million in 5-year average. What do you think about that?
Higher multiple, but less money, right? So for us, I think we try and focus on the human being aspect of it, right? Like forget multiples and math and all that good stuff. What do you need? Do you want to put $20 million in your pocket? Do you want to structure through and get more? What's important to you? Is enterprise value the most important part of it? Is cash at close? Are you a big believer in your business and you want to keep some chips on the table so that if it grows, you benefit from that growth? I think people get caught up in reading too many news articles and are obsessed with this multiple number as opposed to, oh my gosh, I'm putting $25 million in my pocket as a result of this transaction. Who cares if it's a 4 multiple or a 9 multiple or a 2 multiple, right? Like that's cash money. So we kind of start with dollars and cents and try to ignore what I would describe as the cosmetic aspects of M&A.
Thank you. Emily, what is it that you look for? A buyer will come to you and say, I'm interested in buying this company. How do you think about the target that they're looking at? And how do you think about that borrower to decide whether or not you're ready to get into a relationship with that borrower?
Absolutely. So first off, when what we're looking for from a documentation standpoint to really assess the loan, we'll be looking for a lot of things that you're already collecting as part of your due diligence. So financials to substantiate the historical cash flow, business plan, that contract backlog projections to take a look at the opportunity. And then when we're looking at the target company and we're looking at the level of debt that's coming on, there's a few key ratios that can keep in mind and kind of define what affordability might be. So one being debt service coverage ratio. So you're wanting to, by debt service coverage ratio, you're looking at EBITDA minus taxes divided by interest expense plus the current portion of the long-term debt. Is that going to be at 1.2 times or higher for the combined company? So it's important when they're taking on a transaction that we're not over leveraging them, because after the integration happens, there needs to be a little bit of wiggle room, of course, because we know things don't always go perfectly in year one. So definitely want to target that there's a little bit of room on the cash flow side, and to speak to the target loan amount when we're having these conversations on the buyer of what can we afford. When we're looking at debt to EBITDA, we're looking at 3 or 4 times trailing 12-month EBITDA, and then getting for the bank side of the debt, and the rest can be a seller note or part of the equity injection. And the other thing that we always say to be mindful of is looking at the balance sheet. Is it a company that has been historically all the money's been going out in distributions, or have there been some reinvestment in the company and liquidity in the business? That becomes important. Obviously when a transaction happens, it's going to be levered up a bit, but it becomes important to maintain as the business is acquired and then starts to grow, and the companies want to look at larger lines of credit, for example, that they are concentrating on putting more money in the business. So those are a few metrics that we'll look at with our buyers to make sure that the target company is one that they can have synergies with, but as well as a debt that they can take on and continue to grow from there.
Excellent. I'd like to say a little bit about due diligence. We are now at the 45-minute mark, so I'd like to, ask anybody in the audience if they've got questions. Please feel free to just type them in, and we'll get to those questions. This is a great time to ask. But I'd like to talk a little bit about due diligence, and this is a philosophy of sbLiftOff. But hey, listen, I think that we're right, which is that sellers should disclose the strengths and the challenges of their company to potential buyers prior to signing a letter of intent. Again, that letter of intent is an engagement ring. You want to have terms on that letter of intent that the buyer is going to be able to close on. The seller should not be spending their time spinning unicorns and rainbows about how wonderful their company is. Every company I've ever seen has strengths, but also has some challenges. And it's important that you own those challenges and disclose them to a buyer prior to the letter of intent. And that way, you are entering into a relationship in greater trust that can then have the possibility of closing. If in fact there has been litigation, or there has been a lost contract, or whatever the issue might be, and you disclose it after, or you don't disclose it at all, and the buyer finds it, far more likely, it then becomes an issue of the buyer saying, well, the seller clearly knew about this and they didn't tell me. Can I trust this party? Or even worse, the buyer finds it and then the seller didn't know about it. And the buyer then says, wait a minute, what else don't they know about their company that they're not disclosing to me? It's really important to build the trust. And the way to build that trust is to essentially be the person of character that you probably are. There's lots of talk about, business practices, et cetera. Business practices should be ethical and above board. And that's how you're going to create the trust and relationship between the buyer and the seller to get a stable deal. One of the words that we use a lot at sbLiftOff is empathy. The seller needs to look at it not only from their side, but from the buyer's as well. And the buyer needs to look at it from the seller's point of view. And only by having empathy and the ability to see the perspective of the other party can you anticipate what the concerns are going to be, so that you can create the relationship of trust that will lead to a positive transaction. And when we talk about a positive transaction, I'm not only talking about the buyer and the seller. That seller, virtually every seller that comes to me, basically says they care a lot about the value of the transaction. I don't want to say that money doesn't matter, but they care a lot about their employees. They want to make sure that their employees will be treated fairly, that their employees will have a job. They care a lot about the quality of work that's done, particularly in GovCon. A huge number of the GovCon owners are very mission driven, and they don't want to see that mission diminished upon there being a transaction. So it becomes very important that the buyer and the seller kind of come to a cultural match. And that cultural match is really a values match, where they're being empathetic to each other, because it's not just about the two of them. It's also about the employees and the customers and the community that they support. Adam, do you have any thoughts about that?
I think it's beautifully said. I think it back to that word of trust that we talked about. I mean, we're going to find it. We're going to find it. And once we find it, there's no going back. There's just no going backwards. So, for us, if you're honest and open about the good, the bad, and the ugly, we're not going to hold it against you. It's so much better. It's so much better than being surprised. The same way you guys don't want to be surprised down the stretch, 30 days before you close or something like that with some nonsense. It's the same here. So I totally agree with you. I think it's a crucial part of doing the deal. If you're a seller that doesn't care about your employees and you're really only in it to maximize value, the brand of your business isn't relevant, your legacy doesn't matter, it's all about maximizing value, we're not going to buy your company. It's not going to be us. And which is why we like working with Sharon so much, because I know she doesn't represent people like that. So I think trust and openness is a key component here. Otherwise, you're just asking to get retraded on, which, for the record, we've never done. And it's just a crucial part of the transaction process. So I think you're exactly right.
Emily, do you have some thoughts on that?
Yeah, no, I totally agree. I think being very honest at the beginning is so important because not only does it build trust up front, but there also might be more to the narrative that you can talk about when you're airing these proposed or potential weaknesses. There might be a reason why there is a weakness, and you can have the time to explain that and tell the whole narrative up front rather than something being found out right before a close, and you don't get the opportunity to really talk about the narrative and give the full picture there. At that point, it's too late. You've lost the trust.
An excellent point. We worked with a company that was growing very rapidly, and their working capital was growing at a tremendous rate. By the time that we were seeing them, they were getting $16–17 million of working capital. And I'm looking at that and saying, this is insane. I looked at it more closely and I saw that they were getting paid by their clients in about 60 to 90 days, and they were paying their vendors in less than 30 days. So I said to my client, what are you doing here? You're a bank. You're basically making lending, doing loans to your vendors, and you're not getting any interest on this. Your working capital is too high. This is going to be a problem when we go to market. My client turned to me and said, Sharon, you just don't understand. Our clients are Fortune 100 companies. They're going to pay us. They're going to pay us on their time, but they're going to pay us. Our vendors are guys in trucks, and they absolutely need their money in 2 weeks to 30 days. That's how they pay their mortgage. That's how they put food on the table. By being fast payers for our vendors, those vendors will drop anything to work for us. We have an incredibly loyal base. As a result, yes, our working capital is pretty high, but that's a strategic decision that we've made that is important for our company's success. Well, of course I understood that. And as a result, when we went to market, I put that right out front, and I put it as an asset, not a liability. One of the things that they've done is really bought relationships with their vendors by treating them in such a respectful way. It became an issue that never came up with buyers because buyers were told about it, they were advised why it was being done, and it became an asset as opposed to a liability. So really that kind of disclosure is important. Sometimes it could be a problem, but again, it's more important to be honest than it is to try and brush it under the rug. We say that there are two things that kill deals. The first one is surprise. A buyer doesn't want to be surprised by what happens after that LOI. Sellers don't want to be surprised there either. Sellers are less likely to be surprised if, in fact, they have been forthcoming prior to the LOI. The second is time. Going through a deal process is tiring. It's intense. There's a lot going on. And there is something called deal fatigue. So it is important that when you're working on a transaction, that you do it in the most efficient way possible, in part because of deal fatigue, and in part because if it takes too long, confidentiality begins to be a little more challenging, keeping it quiet as to what's going on in a transaction. Adam, do you have any thoughts about confidentiality in a transaction? Isn't that kind of a stress point between you as a buyer and the seller?
I think unfortunately, if people want to act badly and hurt you, they're going to act badly and hurt you. And NDAs are great and confidentiality agreements are great, but ultimately, if there's a bad actors are going to act badly. Again, I think it's back to trust. I think the idea that a private equity firm would use information gleaned from one company they were looking at to put that company at a competitive advantage through an affiliate or somebody else competing in that market is so beyond the pale and so unacceptable that it's hard for me to like really wrap my head around that sort of behavior. That's horrible behavior, but you do the best you can, right? And again, it's trust. If you think that a buyer might do that to you, it's probably not the right buyer.
One question came in asking about how PE firms value GovCons. And let me talk about that for a moment and then throw that over to you. PE firms value GovCons in the same way that everybody else does. They don't have a special metric that they're using. GovCon companies fall into two different categories. those in the set-aside world and those in the full and open world. Now, it's obviously more complicated than that. You can have a company that is 70% set aside and 30% full and open. But if you're in the set aside world, the valuations will range somewhere between 3 and 6. Now, that's a 3 and 6 multiple. That's a pretty wide range. If you are an 8A, the first question is, are you transferable at all? Because it's very hard to purchase an 8A. Really, 8As can only be acquired by other 8As unless they've already graduated from the program. If you are an SDVOSB or a small business or woman-owned, minority-owned, that kind of set aside, you're likely to be in the 4 or 5 range of your multiple. If you are in the full and open world and you're doing really high-end work, that multiple could be 7, 8, 9, 10. So there's really a major value add that exists for going into the full and open world. One of the things that I think that Sier Capital has been doing is thinking about acquiring companies in the set-aside world at that multiple, growing them to get them into the full and open world and get the higher multiple upon the next exit. Adam, any thoughts on that?
Just other questions like, are you growing or are you not growing? How's your management team look? Are you providing a service to customers that have continued to re-up your contracts, or are you a one-shot wonder? I think those are questions that fit into the narrative of where on the spectrum that you just outlined we would come in at. Also, are you willing to eat your own cooking? You know, maybe we'd go from a 3 to a 4 if you're willing to roll some equity or put some seller note or some earnout, right? What's important to you? I think ultimately business owners should think about this like telling a young child a bedtime story, right? Why am I selling? Why do I deserve this much? What are the good parts of my business? What are the bad parts of my business? And where do I honestly think this company goes 3 to 5 years from now? It's all part of that narrative.
We're getting up to the top of the hour, but Emily, I've got a question for you.
Sure.
You know, we talk a lot about multiples, and it's usually multiples of EBITDA on a trailing 12-month basis.
Mm-hmm.
How do you, as a banker, look at the profitability to determine what amount or what multiple you would use to lend?
Yeah, absolutely. So we're looking at it in a similar regard. So generally, we're looking at 3 to 4 times trailing 12-month EBITDA to find that debt number. And now the overage of that could be made up with seller financing or an equity injection, but generally that's the range that we would look at.
It seems as though like 3 times, maybe even topping out at 3.5 times the trailing 12-month EBITDA. Is that correct?
Correct. Mm-hmm.
What do you do for a rapidly growing company? A company that, let's say, I'm making up numbers here, has 2.5 million in EBITDA, but is growing such that each month it's going up by another 100,000, 200,000. So by the time that the transaction's over, it's not going to be a 2.5 EBITDA company. It's going to be a $3 million EBITDA company. Would you lend on that $3 million because that's what it's going to be at the close, or do you lend on the 2.5 when that transaction started and you started to look at it?
Yeah, so the good thing that we have going for us is it's a 12-month rolling period. So hopefully some of that has been captured in the months leading up to the acquisition that we can point through and before the time of the sale that's grown. But I would say every situation is unique. Looking if it's awarded contracts and it's very clear that that's what it's going to be in 3 months time or so, you know, it's a conversation that we have, and we always take a common sense approach, right? So if you would put your money on the line for it, if it makes sense, if it's trending in that direction, it's definitely a conversation, and then to open up and look at the whole picture of what the overall strengths and weaknesses of the transaction and the confidence that you can have with those mitigants.
One of the comments that we received is that EBITDA, basically the trailing 12 months, is basically looking in the rear view mirror, and that a discounted cash flow is kind of looking forward as to what is the cash that's going to be generated. Do you, Emily, when you're looking at these, look at both an EBITDA multiple and a DCF analysis?
Yes, no, absolutely. We're looking at two sides of the coin to make sure that the transaction is going to make sense. So it is, it incorporates both the rear view and the forward focus.
Fantastic. Jennifer, I'm going to throw it back to you.
Okay, thank you. I'd like to thank our speakers, Sharon Heaton, Emily Zankman, and Adam Altus for a really great discussion, really informative. And to all of you that attended, thank you so much for joining us for your lunch hour. We hope you have a great day, everyone.
Thank you.
Thank you.
Thank you.